In this video, I'm going to share my August update of my TFSA Dividend stock portfolio that has beat the S&P 500 over the years. I'll share our 22 holdings and which stocks I continue to purchase during this crazy, wild, amazing bear market. Let's do this! For those that don't know, my wife and I do our finances together. We have 3 accounts through 2 brokerages, Scotia iTrade and Wealthsimple. As you can see in my Wealthika account, the month of August has been pretty flat overall. We are still down 6% or $11,000 from our highs in April, and that's including our dividends being reinvested. I hope the markets continue to get hammered and the bad news continues to roll in. And as some of you know, I'm just loving it. This means I can drip or buy shares at prices I haven't seen for quite some time, prices that according to my calculations are undervalued. So far, the markets have cooperated in August and continue to drop after the second bear market rally of the year. We can expect a few more bear market rallies in the future. Let's start, like always, with our only ETF in our TFSA portfolio, VFV, Vanguard's non-hedged S&P 500 Index ETF. We hold VFV because it gives us more US exposure and adds stability to our portfolio. I bought 2 shares at an average price of $92.59. I wish I had done that the previous month when the share price dipped into the high 80s. As many of you know, I was away for much of summer and not watching the market and actively reinvesting the dividends as they come in, as I usually do. These market conditions really show why trying to time the market is a losing situation. Over the years, reinvesting my dividends has always proven to be better than waiting on the sidelines to buy at the right time. This time around, it wasn't on purpose, but man, sitting on a bigger and bigger cash pile in my TFSA really hurt. VFV ended the month flat. Right now, it makes up just 0.7% of our portfolio. I'll be growing the position to about 5% in the coming years. I look to add substantially in the event of a major pullback below $80. Our second largest holding is still Power Corporation of Canada at 8% of our portfolio, which is too rich. POW, like most stocks, is still down 22% from its September 2021 highs. As a holding company, Power Corporation's NAV is massive compared to the stock price. Last month is when we dripped our shares. Earnings were released on August 5th, and the expected happened, a profit of $527 million, a drop of 47%. Net profits per share shrunk to 78 cents a share from $1.47, second quarter last year. I think there will be continued downward pressure on the stock price for the foreseeable future. Let's hope it stays in the 8 to 9 PE range so we can continue to drip at a good valuation like it's 2017. Next up, we have the star of the portfolio, a mid-cap utility and Capital Power Corp at 7.9% of our portfolio with a market value nearing $14,000. This is a riskier position for us as a mid-cap, but has performed the best of the bunch this year. It finished the month at an all-time high, just as it did in July. They also had a dividend increase of 6% on August 2nd. That increase was a little lower than their 7% dividend growth rate over the past 5 years. They have increased annual dividend growth guidance to 6% through to 2025, up from the previous 5%. This bodes well for a mid-cap utility like CPX. We're in no way planning on adding to this position at this high valuation, even with its amazing earnings report. The AFFO guidance has been increased by over 15% this year. That extra wiggle room may come in handy as the interest rates continue to rise. Next up, we have First National Financial at 7.4% of our portfolio. FN has done amazingly well over the past few years and raised their dividend again to keep the streak going. They also gave a 5th consecutive special dividend last year. I don't believe there will be any special dividends this year. Let's see what they declare in November though. Of late, they've had some difficulty with the changing market environment in Canada, with rising interest rates that see no end in sight. I have strong conviction that their team will continue to grow and capture more of the Canadian mortgage market and grow the dividend at 7% as they have over the past 10 years. The stock has been fairly flat in August, establishing a new support level. Overall, it's still down a staggering 30% from its highs of summer 2021. Next up, at 6.9% of our portfolio, is Bank of Nova Scotia. The stock price has been sliding since mid-August and is now below the July 14th low. It is still down 25% from its February all-time high. BNS has its back up against the wall. It has been paying consistent dividends for 189 years, and there's no reason that that's going to change. Just the other month, their distribution increased another 3% after an 11.1% increase at the end of 2021. The earnings were just like the market has been expecting. The comps of 2021 are hard to compete with and a little unfair after those defaults never happened. the bank will have to continue to acquire new customers in South America and the new Canadian market if it wants to keep itself as the number 3 bank in Canada. I bought 4 shares at a price of $72.90. This adds $15.48 to our forward annual dividend income at a yield of 5.6%. I hope the price stays depressed until the end of the year. I believe it is great value right now with its PE in the 8s. Let's hope that the bank keeps increasing its revenue in spite of the poor economic conditions. Next is TC Energy Corp at 6.4% of our portfolio. I love that they have grown their dividends for 21 years straight at a rate of 7%. Just recently, they lowered their expected future dividend growth rate. It is now 3 to 5%. TRP continues its downward trend after its June peak, now down 15% from those highs. The yield still isn't where I like to see it, and the growth hasn't been the best. I am interested to see how well it performs in this turbulent market though. The pipeline industry can still perform well when the energy sector is starting to sputter. Sadly, I dripped 1 share at the sky-high price of $67.42 at the beginning of August for a yield of 5.3%. That added $3.60 to my forward annual income. I'll look to add to my position near my cost basis, which falls in line with my rule of 12, not at $67. Next up, we have BCE Inc. at 6.4% of our portfolio. This is a core holding of our TURF model. TURF stands for Telecoms, Utilities, REITs, and Financials, though technically REITs are financials. Anyway, BCE recently raised their dividends 5.1% and have been growing them for 13 years straight. I love telecoms in Canada as they have this huge impenetrable moat and pricing power to perform well in an inflationary period like we're going through. The stock, like many others in August, remained fairly flat. No one knows where the market is going, and I have no reason to think the market will run up in the short term. I'll be looking to add to my telecoms as this bear market continues pulling down these blue chips I've owned forever to new yearly lows. Next up is ALGONQUIN Power and Utilities Corp, which is our renewable energy play at 5.7% of our portfolio. The stock price ebbed and flowed with the market in August. It is still 20% down from its all-time high in 2021. As a utility stock that has been raising dividends for 11 years straight and over the past 5 years at a rate of 7.5%, I'll continue to purchase shares when the price dips 10% below my cost basis. The second quarter results looked decent for ALGONQUIN. Revenues up 18% and net earnings up 7%. They will need to continue to grow revenues and earnings in order for those dividend raises to continue. Given the market conditions, I can see a lot of pressure on the stock price as support looks to have fallen below $17 again. Next is ENBRIDGE at 5.5% of our portfolio. The stock price fell 6% since the end of July. The energy sector was really enjoying a rally during these high oil and gas prices. I do not see this lasting for years. With the economy under pressure, oil prices will be under pressure. With higher oil prices comes less volume and less revenue for ENBRIDGE. So I'll be looking for the next pullback when the energy sector is out of favor to add to this position in a substantial way. At 5.2% of our portfolio, we have PEMBINA Pipeline Corp. This is a stock I had been contemplating cutting from the portfolio as I mentioned in the past. They haven't grown dividends for almost 3 years and have a 5.8% 5-year DGR. And then guess what? The rumors panned out. There will be a 0.75 cent monthly dividend increase come October. Their quarterly report at the end of July was really promising too. They have even raised guidance for adjusted EBITDA in 2022. This is the smallest of the 3 pipelines we own. With what is continuing to happen in Europe, I'm fully convinced that gas and oil are here to stay for my lifetime. Like with TRP and ENBRIDGE, in August PPL finished the month down 5% from the beginning of the month. Still not at the lows of the year though. I'm waiting for this to drop below $40 and then I'll begin adding. Next up, we have SmartCentres Real Estate Investment Trust at 4.9% of our portfolio. This is another staple in our TURF portfolio. REITs won't ever fit the rule of 12 I have for myself because of the nature of the business. However, they add immense stability and good cash flow to the portfolio. For those that don't know what I mean by the rule of 12, here's a short explanation for those new to the channel. A stock's dividend yield plus its dividend growth rate should equal 12 or more. Here's an example. A 4% yield with an 8% growth turns into 17% yield and 94% yield on cost at year 20. That's the power of dividend growth and the rule of 12. Now back to SmartCentres. They have 185 properties, in which 114 are anchored by Walmart, $11.7 billion in assets, have 97.6% occupancy rate, and have maintained their distribution despite COVID. Need I say more? Well, I will. They have been slowly increasing their pipeline of projects for some of their prime properties they have in major cities. They had a 5% drop from beginning to end of August, so I dived in for a few more shares with one of our dividend paychecks. I picked up 3.32 shares at a price of $28.19, giving it a yield of 6.6%, adding $6.15 to our forward annual income. I have my eye on SmartCentres as the market continues to pull back. Next is our last utility, FORTIS, at 4.7% of our portfolio. It has grown dividends for much longer than I've been alive, 48 years, second most in Canada behind Canadian utilities, and should be on track for 49 soon. Its 20-year dividend growth rate is a healthy 7.7%. It is well diversified and has stable revenue streams with good, solid, continued growth due to investments. Dividend growth is pegged at 6% through 2025. They have 10 regulated utility businesses, 9,100 employees. FORTIS has a highly executable capital plan that supports low-risk, rate-based growth of 6% until 2026. The stock had a major run-up, hitting an all-time high at the end of May, only to capitulate with the rest of the market in June, and has been choppy ever since, with it ending the month down another 4%. With the share price down, I hope to drip some discounted shares in September. Before we continue with the second half of our portfolio, I just wanted to thank you for watching and supporting the channel by your likes, comments, and subs. It means so much for this journey. And now back to what we love. Stocks. Dividend stocks. Next, we have Great-West Lifeco at 4.1% of our portfolio as a solid large cap. They've been steadily growing their dividends for 7 years straight, just like their parent company, POW. The quarterly report last month wasn't good. Their earnings season has been going just as everyone thought, with most companies not looking good with the year-over-year comps. GWO traded below $30 for the first time since February 2021. I really like this play for its yield and as a value play. I used some leftover monies in one account to purchase 0.1 shares for $3.10. Every little bit helps. Next is MANULIFE Financial Corporation at 3.8% of our portfolio, valued at $6,500, which is below my book value. Most of that growth has been from dividends reinvested though. MFC is a very diversified business which has a large presence in China specifically. Their share price has struggled since the financial crisis, which doesn't bother me one bit. We're in the accumulation phase of investing, so the lower the better for high quality dividend growth stocks. Manulife's quarterly report was in line with others in the industry. A nice takeaway was that MFC had repurchased approximately 2% of their common shares so far this year. Another highlight, which is a low light, is that core earnings were down 9% from 2Q21. Their stock price is down 4% on the month. These moves are starting to feel and look normal, which they are not. Its PE is ridiculously low, way below its 5-year average. I'm still looking to increase my position. Next up is TELUS Corporation at 3.7% of our portfolio. TELUS is TELUS, and I love the stock, but I don't like the company. They raised their dividends again this year and have been for 18 years, over the past 10 years at 8.7%. This stock, like almost the whole market, pulled back huge in June and is up 7% from those lows. Overall, for the month of August, it was relatively flat. I need to add to this position quite a bit to bring it in line with BCE. I'll look to even these out if the opportunity arises. Next up is a small cap asset management company in FIERA Capital at 3.5% of our portfolio. This remains high risk. They have a 5-year dividend growth rate of 6.4% with a yield that is a major risk factor at 9.5%. Their assets under management have dropped 12.7% compared to year-over-year comps, really hurting the stock price. The standouts from their earnings report was the lower revenue and AUM, the renewed normal course issuer bid of 4 million shares, and they increased their borrowing capacity from $600 million to $700 million. I still believe they are capable of maintaining the dividend. Growth in the future seems slim though, but with that yield, I'll continue to wait until the time is right to offload them. As I mentioned before, FIERA Capital has been dragging my TFSA down, so once it gets back to near my cost average, I'll be reducing my position size. CANOE EIT Income Fund is making up 1.8% of our portfolio. This income fund is paying us a steady 10-cent a month distribution for years. For now, we take the income and reinvest elsewhere. Canadian National Railway is our only industrial stock at 1.7% of our portfolio. CNR fits the rule of 12 I go by, increasing dividends for 26 years straight with a dividend growth rate of 14.2% over the last 10 years. They are one of 2 big players in the railroad industry in Canada with an impenetrable moat. The stock price just recently started to tail off after recovering in August. I haven't really added to this position over the years, and I really should have. It has provided me with a CAGR of about 13% over the past 4 years. I love stocks that continue to grow their revenue year after year, quarter after quarter, and increase their dividends as fast as CNR has. I want to increase this position. Next is my favorite bank, my pump stock, not my dump stock, Toronto Dominion at 1.1% of our portfolio. This was a large holding. However, for those new to my portfolio, I trimmed it when the stock price was over 100 back in February, and I couldn't see the rationale for it. This does go against my rule of not trimming my winners, but I just couldn't justify the price and felt the run-up was a good 10% too far. TD is the best-run bank in Canada in my opinion and has a huge presence in the US. It has a 5-year DGR of 7.9%. I expect another raise come the end of the year. The earnings were in line with all the other banks in August. Its quarterly net income year-over-year comps were down $300 million. The year-over-year comps again. I really don't like these quarterly reports. I wish they made them yearly. From when I added to our position last month, the stock price has risen 6%. I would be happy for TD to run 6% in a year, let alone 6 weeks. Next is our last bank, Canadian Imperial Bank of Commerce at 0.9% of our portfolio. This is another bank that I trimmed during their all-time highs. This is the smallest of the original Big Five banks and is heavy into real estate. I feel the Canadian real estate market will be depressed for some time moving forward, meaning this will underperform the sector. They're still a decent dividend grower at 5.4% over the last 5 years. CM ended the month down 5%. I should be making a decision soon on whether I keep my remaining shares or not. I may just cycle the position into TD. Let's see what the market suggests I do. I hate making adjustments to my portfolio, but CM has really lagged behind TD, the best performing bank for us. And lastly, our smallest at 0.6% of our portfolio is GOEASY Ltd. They are in the credit services industry. It is a high-growth, small-cap stock in the financial sector. GSY had a good earnings report as expected. When Canadians are in a pinch, this is where they will come. One thing that stood out to me was total same-store revenue growth of 16.8%. That's impressive. GSY is still down 45% from its all-time high in September of 2021. This is a high-risk, high-reward dividend growth stock.
And our largest holding is still
RIOCAN Real Estate Investment Trust at 9.3% of our portfolio. This position became number one during the 2020 crash to bring down my cost average, not expecting the distribution to be cut in early 2021. They have $14 billion in assets and a ton of properties under development in the Toronto area that will add to their AFFO. Their earnings report in August was good. Occupancy is at 97%, revenue is up, and FFO per unit guidance of 5 to 7% is maintained. Development spent is down about $50 million. The stock price fluctuated quite a bit, but finished the month flat. I dripped 2 shares and bought one at an average cost of $20.61, adding $3.06 to our forward annual dividend income at a yield of 5%. So there you have it. All 22 of our holdings and what purchases we made this month with our dividends. We deployed a total of $695.78, adding just over $30 to our forward annual dividend income this month at an average yield of 4.3%. No fresh cash was added, of course, as I max out our contributions in January each year. Thank you so much for watching and helping the channel out with your likes and comments. Until next time, I'm Mr. Financial.